Back in the late 1920s, we had something called the Great Depression. It's likely something that you've heard about before because you've probably read about it in a history book somewhere, but it was a very real situation that could actually come back to haunt us. Let me explain. After World War I, we had the Roaring Twenties with a booming post-World War economy. The troops were back from fighting, women were now starting to enter the workforce, and economic output massively increased. Now, with the economy feeling flush, money was certainly flowing in abundance, and people felt so flush at the time that they wanted to turn their money into more money, so they decided to start investing into the stock market. Between 1921 and 1929, the Dow Jones Industrial Average increased 471%. as investors were laughing their way all the way to the bank. Both greed and speculation was the driving force behind this level of growth. But there was a problem, because very little consideration was being made for market valuations nor the profits of a company. And when these companies clearly couldn't meet the expectations which their shareholders had, investors quickly started to realise that they'd paid too much. And as a result, the unloading started to begin, selling like you absolutely wouldn't believe. On October 29th, 1929, Black Tuesday came. A record 16 million shares traded on the New York Stock Exchange in a single day. Billions of dollars lost and thousands of investors wiped out. Panic then set in and the Dow Jones went on to fall 90% in the following 3 years. Unemployment hit record highs of 24.9%, queues for food banks, homelessness and protests quickly became more common, and a deep economic recession began. Now in today's video we're going to look to evaluate whether a similar kind of depression could occur nearly 100 years on. After all, we're certainly heading in a similar direction, with the US stock market having its worst start to the year since the Great Depression of 1929. And let's not forget, that's after a comparable 400% growth in the stock market since the last crisis. But instead of the Roaring 20s, instead it was the Roaring 10s or 2010s or however you want to put it. It doesn't exactly roll off the tongue too well, but you get the picture. So as we move into a bear market of complete unknown size and scale, questions are now being asked as to whether the same fate could be upon us. Now this is obviously a multi-pronged economic problem with multiple different variables and multiple different layers of analysis that we can certainly look into. But whilst we'll discuss as many of those variables as we can pack into this 10-minute video, towards the end of the video we'll actually look to discuss some of the potential solutions at the problems that most people are going to inevitably face into. So let's discuss the hardest hitting problem right now, which is inflation. Now of course inflation is okay, but only when it's under control. But when we enter into an inflationary period of 5% or more, that's really when the problems start to arise. And unfortunately for all of us, it's certainly due to get worse, because the Bank of England have recently forecasted inflation may rise to 11% by the end of 2022. And they're also expecting that it's going to take an additional 2 years just to get inflation back to the Bank of England target of about 2% per year. Now of course that certainly creates a multitude of issues, because once inflation starts to rise above that 5% threshold, consumers really start to feel it in their finances, because the simple fact of the matter is wages don't keep up. And when wages don't keep up, of course people can't spend as much money. We've already got reports of people asking the cashiers at supermarkets to stop scanning items because the amount has risen too high for their weekly shop. Now, if we've already got people feeling the pinch on their finances at this point, well, it's only ever going to get worse in the coming months ahead, because this inflationary problem is only going to become compounded due to reasons completely out of our control. In October this year, the energy price cap is expected to rise by 51%. Mortgage rates are also jumping to multi-decade highs thanks to central banks hiking interest rates, which are also forecasted to increase throughout the course of this year. And some retail banks are now starting to take liberties, because with the Bank of England recently hiking rates by 25 basis points, some banks are using it as an opportunity to cream a layer of profits off the top by an additional 25 basis points too. So it's double pain for all of the homeowners out there. Now as a knock-on effect to all of this, a recession is inevitably inbound, with economists suggesting the likelihood of a recession within the next 12 months is about 44%. Now to be honest, I personally feel like it's probably 90% certain that a recession is certainly going to be on the cards. Consumer finances are already getting pinched, which will inevitably result in a halt in consumer spending, and therefore we'll probably be in deep recession before we know it. Because actually when we look at the historical data, anytime inflation has actually risen to about 5% or more, apart from after World War II, there's nearly been always a recession thereafter. But the question still stands around how deep of a recession will it be? Could it even be a depression? Because recessions are typically short-lived. Yes, we see a couple of quarters of negative GDP growth, which whilst it can certainly have longer lasting effects on the economy, it's usually short and sharp. Whereas a depression, on the other hand, like we saw between 1929 and 1932, is completely different because it's defined as a long and severe recession in an economy or market, with the point of emphasis being around it being long and severe. But how long could the recession last and how severe might it be? Well, with consumer confidence at a level which we haven't seen since the financial crisis of 2008, then I'm certainly going to forecast that it could be quite bad, because your broader consumer sentiment will certainly have a big impact on the economy. Because if consumers start to tighten their belts and start to cut back in preparation for to hit the fan, it will eventually grind the economy to a halt. And the financial crisis wasn't exactly a great time for many people. The stock market cratered 56%, unemployment reached 8.5%, which was the highest in 2 decades. UK house prices dropped just shy of 20%, business bankruptcies shot up to record highs, yet despite all of this hardship, interestingly enough, personal savings actually increased to the highest point in over a decade, which of course is an extremely important point to focus on, because whilst the economy, businesses and pretty much everything else comes crashing down around us, it's very important for us to take control of our own finances. Because whilst I certainly appreciate there are different circumstances for every single one of you guys out there, the severity of a recession or perhaps even a depression will certainly depend on our ability to not only generate money but save it too. Now don't get me wrong, part of that will somewhat be out of our control, especially if unemployment skyrockets just like it did back in the 1929 depression. And already we are starting to see early signs of this unemployment rate increasing, with big companies actually looking to cut back staff over recent months. Companies like Netflix, Tesla, Coinbase and JP Morgan, amongst many others, are already trimming their workforce in order to prepare for the worst. And whilst these companies are preparing, it's also just important that we look to prepare too, which is where there also needs to be an element of self-accountability in order for us to actually help ourselves. Because our ability to generate money isn't solely dependent on our ability to turn up to a 9 to 5 job and get paid at the end of the month. Rather, it's dependent on the skills which you have that you can offer to the marketplace and inevitably get paid for them. So whilst we're talking about preparing ourselves just like a business would, it's also probably worthwhile thinking about your finances just like a business would too. Now what I mean by that is to start to think about your income or your revenue just perhaps like a business. Now of course the goal for any business is to increase their revenue figure every single year in order to continue to grow their business. This same philosophy goes for us guys when we're trying to look to beat an inflationary economic climate, because if we can increase our income every single year faster than that of the rate of inflation, then at least our overall buying power certainly won't decrease. Secondly, the next thing to think about is that every business has a balance sheet. You have assets on one side and liabilities on the other. Now, as we know from when we do stock analysis, one thing that I personally always look at is a company's current ratio. It simply compares the company's current assets to their current liabilities. Now, of course, a stock or a company with strong financial health will have more assets than they do liabilities, and therefore they have a current ratio greater than 1. And the same target should certainly apply to your own personal finances too, with the aim of the game to acquire as many assets as you can, whilst of course sensibly acquiring perhaps good debt in order to facilitate future growth. If you can aim to do all of those things and start to treat your personal finances just like a business would treat their own business finances, whilst it might not be a completely green light to financial success in the short term, over the long term, it certainly should put you in a good position. So there's certainly my thoughts on this whole economic recession, depression, whatever you want to call it. But be sure to let me know what your thoughts are down in the comment section below. And as well, guys, if you did enjoy the video, be sure to drop a like on it as well. Before you go, YouTube thinks that you should check out this video next. With that being said, I'll see you over in the next one.